Welcome back to the Investing on the Go podcast brought to you by FundCalibre. This week offers an insider perspective on Asian markets as we cover how to evaluate AI opportunities, navigate dividend growth, and balance income with long-term capital growth in the region.
I'm Chris Sarley, and today I'm delighted to be joined by fund manager Richard Sennett. Richard has the distinction of managing 3 elite-rated products at FundCalibre in the shape of the Schroder Asian Alpha Plus Fund and the Schroder Asian Income Fund. He also manages the Schroder Oriental Income Trust. Richard, thank you very much for joining us today.
Well, thank you very much for having me.
It's no problem at all. Let's start with tech, which obviously Asia is sort of home to some of the fastest growing tech companies in the world. Obviously, AI has had an amazing run, particularly in the US. How do you assess AI as a theme in Asia? I mean, are there sectors or countries you particularly prefer? And you know, is the opportunity a bit further behind? Is the upside still there? Maybe just talk to us through that, please.
Yeah, sure. As you say, obviously AI is a very strong, powerful global theme. But I think from an Asian perspective, it sort of really manifests itself in the sort of really the enablers around AI. So it's much more in the companies that supply into the US hyperscalers, for instance. So the people that manufacture the semiconductor chips and the associated products is where Asia is particularly strong. So here you're thinking of companies like TSMC, Samsung Electronics would be examples of that. And where we tend to find those companies is largely in North Asia, so Korea and particularly in Taiwan, which have quite long supply chains and have got and have got a rich sort of deep bench of companies which have exposure to that particular theme. And I think, you know, as long as there is this structural growth in AI demand and the need to continually increase spend there, those companies will be beneficiaries of that. So Korea and Taiwan benefiting from that. You are also seeing places like China increasingly look at getting into some of that manufacturing side of things. It is a bit harder for them around some of the restrictions that they have. But where I guess they've been a bit more sort of in the news you would have seen over the course of the last sort of 12, 18 months is more around their sort of large language models and so on. So if you think things like DeepSeek, remember we had that sort of DeepSeek moment a year ago, which was their particular large language model, which was shown to be, you know, very powerful. And their internet platform companies there are, you know, a bit similar to what we've seen in the US around the hyperscalers. There have been investing quite a lot in semiconductor capex related to AI. But for now, at least, it's difficult to know exactly where the sort of returns from that are going to come.
When you say capex in related to AI, is that things like, I don't know, you know, the warehouses that the electrification, that's that sort of thing around AI, you know, having the hubs that can sort of can take the energy on board, that sort of thing. What sort of things are you looking at in terms of those related capex opportunities?
Yeah, within the internet platform companies is a bit more around sort of just investing in compute power, so semiconductors, those sorts of things. But there are other companies which sort of which you can get exposure to, which include things around, for instance, as you say, the sort of power supply into those data centers. Which
data centers is the word I was butchering and couldn't think of. That's what I was thinking. Maybe China or someone like that might excel there.
Yeah, so yeah, they are building those out, and they are supplying into different parts of the supply chain. I mean, interestingly, across Asia and globally, there are other areas which are benefiting from this sort of things along the reorientation of the grid, spend on capex related to transmission and distribution for obviously supplying into those what is a power hungry industry, and all those industries do benefit from that. I'd say that the other side of the coin within a sort of AI perspective is that more recently, I guess we've seen in markets globally is a bit more sort of focused on some of those companies that potentially sort of could be losing out from sort of AI disruption. And so they tend to be more on the sort of software side of things. So asset-light companies, for instance, where they're investing, they tend to be more in either software as a service, or they could be in sort of e-commerce platforms, or travel, online travel agents, for instance, would be other examples of that. They're companies which potentially do get a bit disrupted from this, but it's a lot. We don't know how it's all going to pan out. So it's still very early days there. From an income perspective, we don't tend to have much exposure to those sorts of companies because they don't tend to pay much in the way of dividends. And the other, from a geographic perspective, I suppose the only other point worth mentioning on that side of things is for India, which has obviously been historically a centre of IT services provision, and there, that is an industry where potentially you see AI disruption as AI becomes more proficient at coding and those sorts of things, and so less manpower is sort of required and so on. So that's sort of a bit of a headwind for that industry.
Okay. Obviously, AI is a big theme that takes up a lot of column inches. Maybe just talk me through some of the other themes that have been that sort of where you see the opportunities in Asia in the next sort of 3 to 5 years. I mean, you've got regime changes, you've got the likes of the new programming career. What are the sort of one or two that sort of jump out to you as the opportunities?
Yeah, and you're right, because I think everyone gets quite fixated with AI at the moment. I suppose, unsurprisingly, and the market has reflected in that, in the sense that it has been quite narrow. I guess from my perspective, what I'm sort of been encouraged to see more recently is that there has been a bit more of a broadening out of the market. Certainly from an earnings perspective, and I think if that continues, that's obviously is encouraging. I mean, some of the areas that I like outside of AI have been some of the things where I've been overweight for a while, include things like financials, and that is a sector which is it's a sector where it's quite broad in the sense it's quite heterogeneous. So it's not just banks, it's also insurers, it's also exchange companies, and the long-term growth which we're seeing coming through in Asia more broadly should benefit those companies as penetration of sort of financial products improves. So if you think sort of insurance products, for instance, so life, all sorts of different forms of protection, health, and so on, very lowly penetrated in Asia compared to Western markets. And as things as the market grows and the economies continue to develop, we should see increased penetration of those products, which will drive those industries. And on a sort of similar tilt, you can see that happening in banks, in a sense, as banks we sort of think of as being lenders, and of course that's a very important part of their job, but also an area of growth from an Asian perspective has been sort of how the sort of wealth management side of those businesses has been growing over time, and that should continue to grow and be of increasing importance for some of the banks across the region as well.
You mentioned those banks and the financials in general, insurers, etc. Is it widespread, or is it centred on countries like Singapore and Korea in particular?
Yeah, so from a Singapore perspective, we have been overweight in the banks there, and I guess Singapore's sort of been benefiting. Certainly, the financial sector's been benefiting from its sort of increased importance as a financial hub within the region, and that has been a real driver of those the wealth management side of those businesses, but the businesses more broadly. The other thing I'd say that's been a bit of a help for some of those Southeast Asian banks has been the sort of diversification of supply chains out of China into Southeast Asia, and obviously Singapore banks and other banks in Southeast Asia are obviously there and can help finance the associated expansion which goes along with that. So they have been beneficiaries of that trend. The other thing, I think, from a sort of, and I think you alluded to there by sort of pointing to sort of Singapore and Korea, is that some of these countries have got certainly have made strides or have continued to make strides or improving their focus on shareholder return and capital return. So Singapore's always been a pretty good dividend pay and return of excess cash, but over the last couple of years, the banking sector there has started to optimize that, given the high levels of sort of capital ratios that they have. But in Korea, it's been more around a program of sort of value up, historically, a bit like that we've seen in Japan over the last couple of years. And there, I guess the story has been a bit more of a focus on improvements in corporate governance, shareholder focus, and this has seen some companies start to increase their dividend payout ratios, for instance, and some of the banks have been examples of that.
Okay, just quickly on Singapore before we move on, do you see it as a bit of a portfolio, a bit of a diversifier, or are there certain attractions to it compared to other countries from sort of a portfolio construction perspective?
Singapore has traditionally been a bit more defensive than other markets in the region. It's been good at returning cash to shareholders. Its corporate governance has generally been pretty good, and therefore it tends to be slightly lower beta than the rest of the region. But even there, we over recent year or so, we've started to see improvements in shareholder focus as well. As I mentioned, in the banks, that's come through in increased dividend payouts and even share buybacks. But also in other industries, there has been a sort of, if you like, a consolidation in some of the poorer returning areas, and that has made for what is quite a good market structure. And in these sort of uncertain times, it could prove to be a bit more resilient than some other markets.
Okay. You mentioned a bit earlier, obviously, the uncertainty at the moment. I'm going to timestamp it for listeners in case they think we're out of date or anything, but it's sort of the morning of the 24th of March. So obviously the war in Iran's caused a lot of uncertainty in terms of oil prices surging, issues with supply routes with the Strait of Hormuz being disrupted and closed, which is sort of 20% of the oil goes through there. We're getting lots of concerns and analyst implications on global inflation, energy costs and markets. How do you evaluate the impact of that in Asian economies and markets broadly, or do you just try and ignore it in terms of how you manage the funds and the trust for the longer term?
Obviously, what's going on has implications for Asia and the region, not least of all that Asia is a net importer of oil and gas. So from the perspective of a rising oil or gas price, that clearly is a headwind, and the knock on to sort of potentially onto interest rates, etc. Can be an issue, or could be an issue if rates were to go up globally, as it sort of tightens liquidity. I mean, we very much sort of manage the portfolio from a bottom-up perspective. So we're very much focused on the companies, the sort of durability of the returns of those businesses through time. And we try to take a longer-term view on companies. The analysts who are based out in the region, they'll go out, and part of their role is to sort of factor in not only a base case for evaluation, but also a bear case and a bull case, and that provides a good framework to understand what's being priced into stocks at any moment in time, and that can be useful if you're taking a longer term view about when you want to be buying or selling companies.
So someone like India, for example, that has that bit of association with the higher oil price not necessarily being the best thing, is it just a case of that's there in the background to be aware of rather than directly impacting those companies straight away?
It depends on a sector by sector basis. I mean, clearly some companies are going to be impacted more directly by rising fuel prices or the macro environment. But it is very much a case of going, looking at the business, looking at the long-term potential of that business. Where are its returns versus its cost of capital? Where do we think they're going to lie, over, not just the sort of next year, but potentially over the next 5 years, and how much of that is priced in, if you like, into the individual stock name. So it's hard to disassociate yourself completely from the macro events that are going on, but the principal driver of the way that we manage the money is on a stock basis.
Okay, I wanted to finish by asking a sort of few questions on the shareholder-oriented income, the trust, ideally. Obviously, it's a dividend, AIC dividend hero, so it's had next-gen dividend hero. It's got 19 years of dividend increases, and I believe it, hopefully, touch wood, celebrates its 20th anniversary later this year. Maybe just talk to the listeners about how you sort of balance the search for income and capital growth, and how you communicate the trade-off between sort of yield and growth potential.
Yep. I think it's an important point, because it does mean that the vehicle perhaps can perform differently in different sorts of markets. And I should say, from an income perspective, we're very much focused on, generating a natural income, if you like. We're not looking to pay out of capital. Obviously it's a trust, so we do have reserves that we can use, but they've been obviously generated by previous dividends paid by underlying companies over the years. So it's very much that focus on natural. Therefore, the types of businesses that we're going to own are naturally going to have a natural income, because we're going to need to have dividends paid by those companies that can then be paid out to shareholders within the trust. That income rationale does mean that you're likely to have a bit of a value tilt to the trust, rather than a sort of it being more focused on a growth area. And that's because there are certain areas of the market where perhaps you're likely to get less exposure to, that don't really pay much in the way of dividends. So, within an Asian context, one of those areas would be, say, Chinese internet platform companies who don't pay much in the way of dividend, and so we don't have much in the way of exposure to that area. But what we don't do is just screen the universe for the highest yielding stocks and sort of backfill the portfolio with that. What we're looking to do is to buy into companies that have got an income rationale to own them, but they've also got potential upside to their fair value as well.
That must be interesting for you, because you've got places like we talked about Singapore and Korea, but you've also got places like China where it's becoming more of a dividend culture slowly there. Is the pool growing as fast as it's ever grown for you at the moment?
Yeah, I mean, there definitely, if you look at programs across the region that are focused on improving shareholder returns, as you say, we're seeing that clearly in Korea, in Singapore. We're seeing it in, as you say, mentioned it in China among certain companies. So from that perspective, there is a push to, in a lot of these markets, to improve shareholder returns through dividends, but also sometimes through buybacks. As well. And part of that is driven by domestic investors in those countries that are asking for more dividends. The other thing which I think is important is that, when you look at Asia as a whole, it's a big region, and there is a lot of choice from a dividend picker's perspective, if you like. So for an active manager of money in Asia to find names which are in different economies, different industries, of interest from an income perspective, and therefore it's quite a good diversifier from that perspective. And people sometimes question the resilience of dividends coming out of Asia, and yes, Asia is a bit of a cyclical market, but payout ratios are generally quite low, and what that does mean is that if things do slow down, there's not necessarily a direct need for companies to cut their dividends in line with the fall in profits.
If memory serves, the income trust, the strategic income oriental income, still has tech as perhaps its largest sector exposure, but you have been trimming it down a bit recently. We talked about AI earlier. Is that just a concern about how expensive things are becoming in AI, or are you just finding better opportunities elsewhere? Maybe just run us through how that approach is to tech within the Oriented Income Trust.
Yeah, you're absolutely right. If you looked at the trust sort of 12, 18 months ago, we would have been overweight in IT. We've been selectively reducing that over the course of the last year or so, and that that is a reflection of, in part, how well the sector as a whole has done from a valuation, from a price perspective, and what that means for valuations of the sector. But it's also a reflection of AI is clearly a great structural industry from a growth perspective, but it will most likely be cyclical as well, in the sense that at the moment supply of a lot of the semiconductors is relatively limited, and there's little supply coming on over the next 1-2 years. But as we get closer to that coming through, people will start to be a bit more concerned about potential supply coming on, particularly if some of the returns on the investment that these big US companies are making doesn't pan out as they expected. So all I'm doing is really recognizing the fact that some of these stocks have done quite well on that basis, rather than sort of a big shift in view of the underlying fundamentals.
Okay. And you mentioned the fundamentals there, but obviously there's a few areas that you have sort of been adding to in the defensive sort of space, the likes of utilities, consumer staples and healthcare, but perhaps not the things that people immediately think of when they think of Asia, perhaps a bit more when it comes to Asian income. Maybe just explain the reasoning behind it. Is it the uncertainty, or is it the ripples of China's changing views? What's pushed you into those three areas?
Yeah, I mean, it's more around, I think, not that I've sort of suddenly got a bearish outlook for the region, or that I want to, because of what's been going on or anything like that. I mean, I've been slowly doing this over time. It's more a reflection of where the stock opportunities are coming up from a valuation perspective. Those sectors that you mentioned have lagged the overall market over the last 12-18 months or so, and therefore, unsurprisingly, from a valuation perspective, they're starting to throw out more opportunities from a stock perspective than they had done previously. So again, it's that sort of, I guess, a natural sort of rotation that you see as valuations in some areas start to become a bit more full. In other areas, they naturally become a bit more attractive. So it's a reflection of that.
And just quickly, in terms of the overall balance of the portfolio, so obviously in tech, you'd expect the sort of the growth element to be stronger and the sort of the income and dividends to be slightly lower. When you move away from that, do you try and maintain that balance by looking for other areas where it's more leaning towards growth over income, or is it, if the shape of the portfolio changes, you're just happy to accept that?
The shape of the portfolio, changes because of the sort of, if you like, the pull on capital from relative from individual stock names. What I'm not doing, if you like, is saying, oh, I want to buy a growth stock here and a defensive stock there as such. I'm looking at the individual stock and what I think its potential return could potentially be over time, the income rationale, and so on and so forth. And because of that income rationale, I think what you do see relatively consistently through time is that the sort of overall blend of the portfolio will end up on that sort of with a value tilt rather than a growth one. And the size of that may depend a bit on what's in vogue or not in vogue at the time.
Okay. On that note, Richard, thank you very much for spending some time with us today.
Not too well. Thank you very much for having me.
To learn more about any of the products mentioned in today's interview, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.